It's Tuesday, 2nd of June, 2026. Welcome back to your news update on Blip Brief, crisp but almost everything updated every market trading day. By the previous close, both the broader Indian indices slipped just under 0.7%. And, for you, the sharp professional watching your portfolio on the morning commute, a sea of red on the terminal, is a pretty jarring visual.
Oh, absolutely. But if you look at the institutional flows, this really wasn't a domestic panic. The underlying architecture of that 0.7% slip points, well, entirely to persistent foreign institutional selling.
Right, mostly amplified by global market uncertainties, I imagine.
Exactly. We are witnessing a structural rebalancing. When developed markets begin shifting their yield expectations, the risk premium attached to emerging markets is instantly recalculated. Algorithms in New York and London just flip the switch.
So capital flows out of Indian equities not because the domestic story is broken, but just because the global cost of capital is forcing these massive funds to consolidate.
Yeah, that's exactly it. It's a global consolidation, really.
Which makes mathematical sense, but it doesn't explain the anomalies on the board. I mean, usually when foreign capital executes a coordinated exit, it drags the entire market cap down with it.
You'd think so, yes.
But sifting through the sectoral data, the IT and pharma indices just completely ignored the broader sell-off. They didn't just hold the line, they actually rallied. So what is insulating them from this flight of foreign capital?
Well, the insulation comes from a very specific pivot in utility. Take the IT sector's rally, for example. Historically, Indian IT served as the back-end maintenance hub for global corporations.
Right.
But the current valuation surge is driven by a massive wave of new, highly lucrative AI-led partnerships. The market is finally recognizing that global enterprises cannot simply buy an artificial intelligence model and just plug it in.
They need the infrastructure.
Precisely. They require massive, customized data architecture. And Indian IT firms are securing the contracts to build that exact digital plumbing. They're cleaning the enterprise data, structuring the cloud environment.
Basically building the integration layers that make AI functional for Fortune 500 companies.
That's exactly right.
So the market isn't just buying IT, it's buying the foundational infrastructure of the entire AI boom. It's the classic, selling shovels during a gold rush strategy.
It really is.
But how does that logic apply to the pharmaceutical space? Because Wockhardt stocks surged aggressively, and they operate in a completely different regulatory universe.
Yeah, the mechanism behind Wockhardt's surge is a textbook example of a regulatory catalyst unlocking a global commercial bottleneck. The trigger there was the US FDA approval of their novel antibiotic, Zanich.
Oh, wow. Okay.
Yeah, and to grasp the financial magnitude of this, you really have to look at the biology of multi-drug resistant bacteria. We are dealing with superbugs that have evolved insane defense mechanisms.
Like what exactly?
Like efflux pumps that literally spit standard antibiotics out of their cells, or enzymes that degrade the medicine before it can even work. Developing a molecule that bypasses those sophisticated bacterial defenses requires billions in R&D and years of trials.
Right, and clearing the US FDA indicates that the molecule doesn't just work in a lab, but is actually sanctioned for the most lucrative healthcare market on the planet. I imagine the pricing power on a drug that saves a patient when literally all other antibiotics fail is immense.
Oh, it's unprecedented. When a company holds the patent to a proprietary solution for a critical unmet global health crisis, its forward revenue projections are entirely rewritten overnight.
Makes sense.
So the broader market might be down 0.7% due to those macroeconomic yield anxieties we talked about, but a firm holding a functional weapon against superbugs just operates on its own valuation trajectory.
Speaking of trajectories, I want to cross-reference this market hesitation with the actual macroeconomic data hitting the streets. Because, look, the indicators we are tracking paint an incredibly robust picture. GST collections rose over 3% year-on-year.
Which is solid.
And April's industrial output grew almost 5%. Plus, digital consumption is accelerating violently, with UPI transactions growing nearly 20% year-on-year and pushing a 3% month-on-month expansion.
Yeah, and the physical asset data reinforces that velocity, too. Passenger vehicle sales are up over 26%, and electric vehicle sales have surged nearly 80%.
Nearly 80%? That's massive.
It is. It points to a heavily capitalized consumer base, particularly in the urban centers.
Right, but here's the friction point in that narrative, though. If purchasing power is that strong and factories are churning out almost 5% more output, why did commercial LPG sales plummet by 24% year-on-year? A booming economy should logically require More commercial cooking gas, not a quarter less.
Yeah, that paradox is perhaps the most accurate diagnostic of the current Indian economy right now. It reveals a really brutal two-speed reality.
Also,
While the commercial LPG data is the footprint of the unorganized sector, the small-scale catering, the traditional street-side hospitality, basically the high-volume, low-margin businesses. And commercial LPG recently saw a price hike of just over 1%.
but a 1% increase seems completely negligible in the context of broader inflation.
It is negligible for a massive corporation. But for an unorganized business operating on a, say, 4% net margin, a 1% increase in a primary overhead like fuel is catastrophic.
Oh, I see. It forces immediate behavioral adaptation.
Exactly. They switch to cheaper alternative biomass fuels, or they just consolidate operations, which officially drops the commercial LPG volume by that staggering 24%. Meanwhile, you have the corporate aviation sector, where international aviation turbine fuel prices just plummeted by 27%.
Wow. So the top end of the economy is flying cheaper, buying electric vehicles at an 80% growth clip, and driving GST collections, while the bottom of the commercial pyramid is being squeezed out of traditional fuel by a mere 1% price bump.
Precisely. The macro numbers look fantastic on aggregate because the organized, digital, and capital-intensive sectors are expanding fast enough to completely mask the contraction in the traditional margin-sensitive sectors.
That sensitivity to fuel prices brings us directly to the geopolitical shockwave currently moving through the global markets. I mean, Brent crude oil prices just spiked over 7% in a single session.
Yeah, a sudden 7% upward shock in Brent crude fundamentally alters the inflation calculus for literally every oil-importing nation on Earth. The underlying cause requires really close scrutiny here.
Well, the catalyst is localized around the Strait of Hormuz. And I look at the strait not as a generic waterway, but as a global toll booth with a single lane.
That's a great way to put it.
You have roughly 20% of the world's daily oil consumption trying to squeeze through a channel that is incredibly narrow. The moment you place military assets or political friction near that toll booth, the insurance premiums on those oil tankers just go vertical and the commodity price explodes.
Yeah, the physical geography completely dictates the economic vulnerability. We are seeing escalating U.S.-Iran tensions, physical clashes near the strait, and a formal halt to bilateral negotiations from Tehran.
In Israel, expanding operations doesn't help either.
Exactly. To compound the regional instability, Israel has expanded its offensive operations in Lebanon. The geopolitical risk premium is now just aggressively priced into the barrel.
And the diplomatic friction from that Lebanon expansion is already hitting Washington. I mean, former President Trump reportedly engaged in a highly confrontational phone call, heavily criticizing the Israeli prime minister over the expanded strikes.
Right. But, the diplomatic theater aside, the focus remains on the structural response of the U.S. domestic economy to all this Middle Eastern instability. Defying expectations of a geopolitical slowdown, U.S. manufacturing just hit a 4-year high.
A 4-year high despite the oil shock.
Yeah, and to accelerate that momentum, President Trump temporarily slashed tariffs on farm and industrial equipment, dropping them from 25% down to 15%.
The timing of that tariff cut is fascinating. Cutting tariffs by 10 percentage points on industrial machinery isn't just a generic tax break. It fundamentally alters the capital expenditure equation for domestic factories.
Oh, entirely.
If I am a U.S. manufacturer, upgrading my assembly line just became significantly cheaper, right as global supply chains look their absolute most fragile.
It is a highly calculated lever to weaponize the global uncertainty. By lowering the barrier to heavy machinery imports, the administration is heavily incentivizing U.S. producers to reshore their supply chains and automate.
Smart move.
But while the U.S. focuses on traditional manufacturing resilience, the tectonic plates of the global equity markets are really shifting due to technology. I mean, South Korea has officially overtaken India to become the world's 6th largest stock market.
Wait, that is a startling inversion. We have been tracking India's steady institutional climb up those rankings for years. What is the specific mechanism allowing South Korea to leapfrog a market of India's size?
The mechanism is silicon. South Korea is the geographical epicenter for advanced artificial intelligence chip manufacturing. We discussed earlier how Indian IT is building the software plumbing for AI, right?
Yes, the data structuring.
Well, South Korea is forging the physical pipes. Their semiconductor giants hold a near monopoly on high-bandwidth memory chips, which are physically essential for AI processors to function.
So they are capturing the hardware premiums.
Exactly. As trillions of dollars in global tech capital flow into AI data centers, a disproportionate amount of that equity value is captured by South Korean hardware firms. That's artificially inflating their entire national stock market capitalization past India's.
So they basically own the physical choke point of the AI revolution. But bringing this back to India, we have South Korea capturing foreign tech capital, and we have global oil spiking 7% due to the Middle East.
A tough combination.
Historically, an oil spike of that magnitude triggers a violent sell-off in the Indian rupee. Yet, looking at the money markets today, the rupee closed perfectly flat. A 0% movement against the US dollar. How is a 0% movement even mathematically possible under this kind of imported inflationary pressure?
It is only possible through direct, massive, and highly coordinated market intervention.
So it's engineered.
Completely. A flat currency in the face of a 7% oil shock is a synthetic construct. When oil spikes, domestic importers panic. They rush into the forward markets to buy dollars to hedge their future energy purchases.
Right. And that avalanche of demand for dollars naturally crushes the value of the rupee.
Exactly. Which means the Reserve Bank of India had to be waiting on the other side of those trades.
Ah.
The data strongly suggests that state-run banks, acting as proxies for the central bank, just flooded the market with dollar liquidity. They systematically absorbed the panic buying from importers, flattening the volatility curve entirely.
That is a highly aggressive defense of the fiat currency to ensure imported inflation doesn't bleed into the domestic economy. But if the central bank is burning reserves to maintain that artificial stability, are domestic businesses feeling a corresponding squeeze on credit? Usually, defending a currency requires tightening domestic liquidity.
You'd expect that, but the domestic credit data reveals a surprising amount of insulation. Currently, nearly 67% of all bank loans in India carry interest rates below 9%.
Wait, 2/3 of the economy is borrowing at under 9%.
Yes.
Okay, well that explains the almost 5% industrial output growth. The cost of capital is still low enough to justify expansion, completely detached from the sovereign currency defense happening in the forex markets.
It is a carefully managed, dual-track monetary environment. But while the rupee is being engineered to remain flat, capital is flowing heavily into non-fiat safe havens. Gold prices rose nearly 2%, and silver moved up slightly under 0.5%.
The nearly 2% move in gold is the market's raw, unmanipulated reaction to the Strait of Hormuz. I mean, you can synthesize a currency's stability, but you cannot stop capital from fleeing into hard money when the geopolitical architecture looks fragile.
Oh, absolutely. Gold functions as the ultimate barometer for systemic terror. That 2% jump quantifies exactly how much risk institutional money managers believe is currently unpriced in the broader markets.
It is truly remarkable that in an era of high-frequency algorithmic trading and artificial intelligence, the global financial system still defaults to a dense yellow metal when it gets scared.
It never changes.
But I want to pivot from the oldest material in the human economy to a breakthrough in material science that genuinely feels like it violates the laws of physics. Let's do a quick deep dive into molybdenum oxychloride crystals.
Ah, yes. The scientific community has been attempting to map the properties of this specific crystalline lattice for quite some time. And, well, the resulting data represents a complete paradigm shift in optical electronics.
Because the fundamental rule of material science has always been a binary choice, right? If you require a material to conduct electricity efficiently, you use a metal, but metals block light. They're entirely opaque.
Correct.
If you need transparency, you use glass, but glass is an insulator. It stops electricity dead. Molybdenum oxychloride crystals somehow operate as both simultaneously. They are completely transparent, yet highly conductive.
Yeah, the breakthrough lies in subatomic traffic management. In standard conductive materials, like copper or gold, the electrons that carry the electrical current move chaotically. When photons, particles of light, enter the material, they crash into these chaotic electrons and scatter, which is exactly why the material appears opaque to the human eye.
Right, the electrons act like a dense fog blocking the headlights.
That's a highly accurate way to visualize it. But in molybdenum oxychloride, the unique atomic structure forces the electrons to flow in highly organized, constrained channels.
So they aren't bouncing around.
Exactly. Because the electrons are moving in these strict, orderly pathways, photons of light can pass straight through the gaps in the atomic lattice without colliding into the electrical current. You basically achieve the conductivity of a metal with the visual clarity of a window pane.
The commercial applications for this are staggering. I mean, tech companies have spent billions trying to develop augmented reality glasses, and smart contact lenses, but the bottleneck has always been the circuitry. You cannot embed traditional metal wires in the center of a lens without blinding the user.
Right. And this crystal is the missing hardware link. With a transparent conductor, the lens itself becomes the circuit board. You can route power and data directly across the user's field of vision with zero visual obstruction.
That's incredible.
It really is. It eliminates the need for bulky peripheral hardware, allowing for digital interfaces to be projected flawlessly onto the physical world.
Which forces us to reconsider our entire relationship with information. Right now, we interact with the digital world by choosing to look down at a screen, and more importantly, we have the physical ability to look away. But when transparent circuitry allows the digital overlay to be seamlessly baked into our natural field of vision, when the screen completely vanishes into the world around us, how will the human brain delineate between physical reality and algorithmic projection? If the data is permanently in our eyes, we won't just be consuming information, we will be permanently living inside it. That is a cognitive shift we are entirely unprepared for.
Very true.
And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.